Most investors think that they're smart, and most people think that investing is the solution. But it turns out that investment gains are generally just driven by the inflation rate. So if you look at this chart, the green line is the money supply in the US dollars, and the red line is the S&P index, the stock index. And as you can see, you could, if you didn't know about the money supply, or if you thought the inflation rate was only 2%, you would think that your stocks are outperforming inflation and your companies are brilliant and they're succeeding and your investment strategy is brilliant and you're making lots of money. But what you can see here is that a portfolio of companies is really just tracking the money supply. The companies are doing things. They may be growing 2% a year, but the same 2% a year of improvement in productivity is being offset by 2% chaos and destruction and risk and liability that people don't pay attention to. And so when you net it all out, a portfolio of companies is really just tracking the inflation rate in the money supply. And that means that if we look across investing and we look at asset classes, you can see the government and the mainstream media would have you think the consumer inflation rate is 2%, that lower. I'm speaking in the US and the US dollar, of course. Obviously, you know, inflation rate is much higher in Argentina. But the most important point of this is we're talking about all 8 billion people in the world, and we're talking about all the money in the world, even under the best of circumstances. This is what they're looking at. So the 2% line is the consumer inflation rate. Most of these investments and asset classes can beat the 2% inflation rate, but as you can see, they can't beat the real inflation rate, the asset inflation rate or the money inflation rate, the rate at which money loses value against scarce desirable assets. Now, as you can see from the chart, the worst investment is a commodity. You don't want to buy oil or natural gas or lumber, because human beings are really good at producing lumber and oil and natural gas. I mean, we use machines, we use factories, we use technology. Is there anybody that doubts that we're better at making oil or gold or silver or platinum today than we were 2,000 years ago? It's kind of obvious. We just get better. And so, you know, commodities and cash don't work. Then if you look at the average investor, they're getting 2.9% return because they're diversified. As I've said before, diversification is selling the winner to buy the loser. Your consumer home is doing a little bit better. Bonds are a little bit better. And the diversified portfolio underperforms inflation. If you look at the S&P index, it's about the same, right? You're getting 7.5% return against about a 7 to 8% inflation rate. But all you're doing is just keeping up with asset inflation. You're not beating it. The only asset classes that beat it by a little bit, REITs, real estate investment trust, it's basically real estate portfolios. And maybe you might beat it by a percentage, but there really aren't any winners here. What this tells you is that if you own the most desirable property in the middle of London or Paris or New York City, you might be able to slightly beat monetary inflation, and most investment ideas don't work. And so if you want to preserve your wealth, an investor has to convert their currency into assets. And, currency, CNY, euros, dollars, ARS, bolivars, real, etc. You have to convert them into assets that are scarce, desirable, portable, durable, and maintainable. Those are the 5 criteria that matter. And you have to evaluate every asset against that. So what is Bitcoin? Bitcoin is the most powerful digital monetary network in the world, but it is simultaneously 4 things. Bitcoin is an asset, it is a network, it is a protocol, and it is an ideology. And many people misunderstand it. They think, oh, it's just a cryptocurrency. But I think when you start thinking about asset, network, protocol, and ideology, your eyes open. Many people say, well, Bitcoin's not backed by anything. What's it backed for? It has no intrinsic value. And they grossly misunderstand the network. Bitcoin is secured by 4 types of power: computing power, electrical power, economic power, and political power. And if you don't understand these four types of power, then you're going to someone's going to trick you out of your Bitcoin, or you're going to make mistakes. So, for example, the computing power is 460 exahash. That's all of these millions of Bitcoin miners, custom silicon, and they are channeling 16.5 gigawatts of electrical power into 460 exahash. Now, 16.5 gigawatts is 20 basis points of the power in the world, so it's a small fraction. But 460 exahash is what makes Bitcoin truly secure, because that's all the computer power in the world. If you wanted to redirect all the computers at Google and Amazon and Microsoft and all of the iPhones to do hashing of Bitcoin, they're probably not going to generate 460 exahash. So it's the custom silicon which converts electrical power into computer power, and they're both important. Arguably, it's a lot easier to come up with 16 gigawatts than 460 exahash, because all the hash power is owned by the Bitcoin companies that are securing the network. Now, to put this in perspective, 16.5 gigawatts is more power than the energy used to propel the entire United States Navy. All of the aircraft carriers, all the destroyers, all the ballistic subs, the entire Navy runs on a bit less than 16.5 gigawatts. So that's a lot of power. 460 exahash is all the computer power anybody else can muster. But that's not the only thing. Bitcoin's secured by economic power. And if you look at the 4-year simple moving average of Bitcoin, and then you look at the supply, you conclude about $560 billion have been invested in, the M is wrong, it's $560 billion have been invested in this network.